Welcome to this explainer covering the latest verified market developments for CATL. Look, if you've been tracking this EV battery giant, you already know the information landscape out there is incredibly crowded right now. So today, we're cutting straight through the noise to look at what actually happened over the last 72 hours. We're zooming in on the data that legitimately moves the needle for your portfolio.
Right off the bat, let's separate the social media hype from the concrete facts. Message boards are blowing up with rumors about sudden solid-state battery breakthroughs or these massive secret mining acquisitions. Honestly, we are ignoring all of that. We don't deal in speculation here. Instead, we are zeroing in strictly on primary source, verified data.
To get us there, we'll quickly map out exactly how we're breaking this down. We'll cut through the noise, look at a really costly victory in Europe, examine a looming cliff in the US, dig into the real bullish signal, and wrap it all up with a tactical playbook you can actually use.
So let's just jump right into it and focus entirely on those verified events from the past 3 days.
There are three primary developments we absolutely need to unpack today. First, the European Commission's conditional approval for CATL's Hungarian plant. Second, a fresh SEC filing regarding their US licensing deal with Ford. And third, the hot-off-the-press August production data from the Shanghai Stock Exchange. We're going to see exactly what these mean for CATL's revenue, their margins, and their overall geopolitical risk profile.
Let's pivot to Europe first, because this recent approval from the European Union is a fascinating double-edged sword.
The headline number here is an absolute monster. We're talking about a 2.3 billion euro state aid subsidy package from the European Commission for CATL's Debrecen plant in Hungary. Now, on paper, this is a massive geopolitical win, right? It secures a huge expansion up to 140 gigawatt-hours and firmly plants CATL inside the EU's domestic supply chain. It essentially bulletproofs them against any future import tariffs on Chinese-made battery cells. You look at that and think, the regulatory dark clouds have finally parted.
But here's the catch, and it's a hidden cost you really need to be aware of. This approval is heavily conditional. CATL is legally bound by some very strict remedy packages. They literally have to slash regional water consumption by 35% compared to their initial proposal, and they have to install public, real-time groundwater monitoring stations. Look, building out that kind of advanced infrastructure is not cheap. Our data indicates this compliance is going to quietly squeeze their gross margins for the European division by about 1 to 2% all the way through 2028. So this isn't just a blind buy on a flashy headline, it's very much a show-me story about operational execution.
All right, let's cross the Atlantic and examine a significantly more complex risk profile developing over in the US.
On August 20th, CATL's U.S. depository receipt sponsor dropped an 8K filing with the SEC, and it gave us some much-needed clarity on their status regarding the Inflation Reduction Act. The good news up front, the U.S. Treasury actually confirmed that CATL's technology licensing model with Ford in Michigan, where, remember, CATL holds zero equity, currently satisfies the Foreign Entity of Concern, or FEOC, exclusion requirements for the rest of 2026. But you always have to read the fine print. The ruling explicitly states this arrangement will expire on December 31st, 2026 and will not be renewed, period. This isn't just some rumor floating around online, this is binding legal text. For anyone with a long-term outlook, you have to consider this a massive red flag for their U.S. exposure.
Let's break down how this timeline is likely going to play out for your portfolio. For the next few months, it's business as usual. CATL happily collects their licensing fees. But by November, expect some major stock volatility. Hedge funds are absolutely going to start positioning themselves ahead of that year-end cliff. And then on January 1, 2027, CATL hits a hard regulatory wall. They're likely going to be forced to sell their technology for a one-time lump sum, or they'll have to adopt a pure royalty model with absolutely zero operational control over that Michigan plant. And honestly, if US-based institutional funds are forced to reclassify CATL under those FEOC rules, we could see triggered mandatory selling. It's a big deal.
Okay, let's strip away all this geopolitical red tape for a second and look at the raw operational numbers, because this is where the real bullish signal lies. On August 20th, preliminary data from the Shanghai Stock Exchange gave us a look under the hood, and wow, the core business is absolutely humming. CATL reported a powerful 12.4% month-on-month increase in battery installations just for August. Amidst all the global policy shifts, this is arguably the single most investable data point we have right now. And it gets even better. When you look outside of China, their global market share is just expanding rapidly. It hit a staggering 38.7%, and that's up from 37.1% in July alone. Think about that kind of growth in just 1 month.
So how exactly are they pulling this off? Well, they're brilliantly pivoting away from the slowing consumer EV market. Instead, they're aggressively capturing massive market share in high-growth, heavy-duty sectors. We're talking commercial trucks, buses, and stationary energy storage systems. If we project this aggressive run rate forward, they are totally on track to beat Q3 consensus revenue estimates by a solid 3 to 5%.
And here's the kicker. Despite the absolute geopolitical minefield we just mapped out, CATL's price-to-earnings ratio is sitting near its 5-year average of roughly 22 times earnings. For a company that is growing at over 12% month over month, this valuation provides a rock-solid fundamental floor. It really proves that core operational strength just can't be completely overshadowed by shifting policies.
So what does this all mean for you? Let's synthesize this data into a clear tactical playbook.
We can break this down into 3 tiers. In the short term, say the next 1 to 3 months, the strategy leans heavily toward buying on dips. You want to ride that strong Q3 earnings momentum and the technical support from that massive EU subsidy. Now, in the medium term, looking 4 to 12 months out, the data strongly suggests hedging or reducing your exposure by November. You want to get ahead of that US FOC cliff and the reality of that 2027 Hungarian margin squeeze we talked about. Finally, for the long term, 2 to 5 years, the move is to accumulate whenever the PE multiple drops below 22. At the end of the day, CATL remains the undisputed cost leader in LFP batteries. Plus, their recycling joint ventures, like the one with VinFast in Vietnam, do a fantastic job of insulating them from sudden commodity price shocks.
To wrap up this explainer, I want to leave you with this thought. CATL is truly living in a tale of 2 worlds right now. On one side, their operational engine is firing on all cylinders. On the other, their geopolitical reality requires constant, hyper-careful navigation. So how will you weigh their undisputed fundamental dominance against an increasingly hostile geopolitical minefield? Thank you so much for joining me for this deep dive into the data, and as always, keep questioning the noise.